Most people assume there is exactly one way to make money in the stock market. You buy a stock for 100 rupees, wait for the price to go up, and sell it for a profit. But there is a completely different strategy, one where you generate a predictable, recurring cash payout without ever having to sell a single share you own. When highly profitable, mature companies reach a point where they don't need to dump every single rupee of profit back into aggressive expansion, they have a choice. Instead of forcing growth, they distribute that excess cash directly to their shareholders. It operates exactly like owning a physical rental property. You buy the building, hold on to it while the underlying value appreciates, and collect a rent check every single month. That stream of passive income is exactly what draws people to dividend investing. But if you execute this strategy blindly, you will very quickly wipe out your initial capital. The fastest way beginners lose money here is by chasing double-digit dividend yield percentages. They sort a list of stocks by highest yield and assume a bigger number means a better investment. To understand why that is dangerous, look at how the yield is actually calculated. This formula divides the annual dividend payout by the current stock price to give you your yield percentage. Because the stock price is the denominator, the math creates an illusion. If a company's stock price collapses because the business is failing, the resulting yield percentage automatically shoots up into the double digits. You have to ignore the percentage and focus on the absolute rupee amount paid out against a stable or growing stock price. A healthy company paying a steady 10 rupees per share while its stock price rises will mathematically show a smaller yield percentage. For large, established companies, a standard healthy dividend yield sits between 1 and 3%. Anything significantly higher than that requires serious scrutiny. A massive dividend yield is frequently a red flag masking depreciating capital. Your primary goal is absolute cash stability, not an inflated percentage on paper. Identifying a healthy company is only the first step. Simply owning the stock on the day they distribute cash does not guarantee you get a check. Every dividend announcement has a rigid deadline, the ex-dividend date. Buy shares even one day after this boundary, and the payout bypasses you to the previous owner. To capture the cash, your ownership must be fully settled before that date strikes. Scaling this across dozens of companies transforms your passive cash flow into a relentless, calendar-driven administrative burden. If you want to build this portfolio yourself, you will spend your time inside manual stock screener tools. You filter thousands of equities, cross-reference payout consistency, check their yield stability, and dig into balance sheets. The obvious benefit here is efficiency. You pay zero management fees and retain absolute granular control over exactly where every single rupee is deployed. You isolate the exact assets you want from the chaos of the broader market, completely ignoring the companies that don't fit your exact criteria. But the trade-off is steep. It demands advanced financial literacy. More importantly, it requires the emotional discipline to immediately sell a stock you like the moment the company announces a dividend cut. The DIY method effectively becomes a part-time job. It rewards those willing to maximize their returns by paying with their own time and attention. The alternative is deploying your capital into prepackaged, algorithmically curated baskets of stocks. These platforms use algorithms to do the heavy lifting. They scan the market and automatically filter out any company that hasn't maintained a strict, stable yield of at least 2% for over a decade. Because the basket is managed for you, the system handles the annual rebalancing automatically. You never have to track ex-dividend dates or manually execute trades. The cost of this convenience is control. You completely surrender the ability to pick individual assets to the platform's algorithm. You also have to clear a higher barrier to entry. Accessing these curated baskets usually requires a much higher upfront lump sum of capital compared to buying individual shares. Automated portfolios guarantee a baseline of stability and let you buy back your time. You are deliberately trading maximum optimization for total convenience. Regardless of which execution path you choose, you still have to deal with the primary friction point of cash flow, taxation. This flowchart illustrates how your payout is reduced. Before the money hits your account, the government skims a mandatory tax deducted at source, usually 10%. The remaining capital flows directly into your standard taxable income for the year. If you are a high-earning individual in the top tax bracket, that payout gets heavily taxed again. Your specific income slab dictates the ultimate value of the money you receive. You cannot evaluate a dividend portfolio based on the gross yield advertised by platforms. A true calculation of your return on investment has to be based strictly on your final, post-tax net income. This matrix graphs your decision. You need to weigh your available time against your actual market experience. If you sit in the top right quadrant with high market experience and the time to do the research, build your own portfolio. Use screeners, avoid the management fees, and retain absolute authority over your capital. If you lack the time to track ex-dividend dates and read balance sheets, you belong in the automated portfolio quadrant. Pay the fee to secure algorithmic stability and eliminate the calendar management. Keep your expectations grounded. Dividend investing is an agonizingly slow wealth stabilization tool. It is not a vehicle for rapid capital growth. If you lose patience and start chasing massive, unsustainable yields, you will ultimately destroy the initial capital you invested. Decide your approach based on the level of ongoing maintenance you are willing to tolerate. Pick your path and let the math work.